The Federal Reserve dropped a bombshell on September 18, 2024, announcing a 50 basis point cut to interest rates. This move marks the beginning of a new interest rate cut cycle, sending ripples throughout the global economy. To understand the Fed's decision, we need to grasp the basics of interest rates. The federal funds rate is the rate banks charge each other for overnight loans, influencing borrowing costs for businesses and consumers. Lower rates make borrowing cheaper, stimulating economic growth, while higher rates slow it down to curb inflation. The Fed's rate cut suggests a shift in its economic outlook, possibly due to concerns about slowing growth or a desire to boost inflation. The federal funds rate is the interest rate banks charge each other for overnight loans, influencing various other interest rates in the economy. When the Fed cuts this rate, it becomes cheaper for banks to borrow, leading to lower interest rates for consumers and businesses. This encourages borrowing and spending, stimulating economic activity. Understanding this rate is key to grasping the Fed's latest move and its potential impact on your wallet. The Fed's recent rate cut signals a change in course, but why the delay? The talk of rate cuts began late last year, but the Fed held off, analyzing a mountain of data. Inflation and employment numbers were crucial factors. Inflation was cooling, but not as quickly as hoped, while the job market remained strong. This mixed economic picture made the Fed hesitant to make any drastic moves. What finally convinced the Fed to cut rates now? It boils down to their economic outlook. Inflation was still above their target, and global economic growth was slowing. The Fed likely saw rate cuts as a preemptive strike to bolster the economy. Understanding the potential implications of their decision is crucial for your financial life. The Fed juggles two main goals: price stability and employment. They aim for an inflation rate of around 2% and want to see as many Americans employed as possible. Lowering interest rates can boost employment, but may lead to higher inflation. Raising rates can curb inflation, but might slow down the economy and impact employment. The Fed analyzes a mountain of economic indicators to decide interest rates. They focus on inflation, employment, consumer spending, business investment, housing data, and global economic conditions. It's a comprehensive examination of the economy from all angles. The Powell pivot signals a shift in the Fed's stance on the economy. Economic data showed cracks, with inflation still above target and global growth slowing. The Fed's rate cut is a preemptive strike to sustain economic expansion and keep inflation in check. A significant revision to job growth figures also influenced their decision. This news likely solidified the Fed's move to cut rates. Inflation has been a major concern, running hotter than the Fed's 2% target. Thanks to aggressive rate hikes, inflation has been cooling down. However, it's still above target, and the Fed is cautious about declaring victory too soon. They're looking for clear evidence of a sustained downward path before fully easing off the brakes. The job market has been strong, but recent data revisions show it might be losing steam. This news suggested a potential slowing economy, creating a dilemma for the Fed. They needed to support growth and prevent rising unemployment while keeping inflation in check. It's a classic case of their dual mandate pulling them in opposite directions. The Fed's rate cut aims to balance these competing goals. Cooling but persistent inflation, a softening job market, and global uncertainty create a recipe for a rate cut. The Fed's decision recognizes these economic realities, aiming to support the economy without reigniting inflation. It's a delicate balancing act, signaling to the markets that the Fed is paying attention and willing to act. The big question is how this rate cut will impact the economy and your financial life. The Fed has started its rate-cutting campaign, but how much lower will they go? Analysts predict a series of cuts, potentially lowering rates by as much as 2 percentage points. The Fed's decisions will depend on how the economy responds to these initial cuts. They need to navigate carefully, avoiding the hazards of both inflation and recession. The Fed prefers swift rate cuts to manage expectations and maximize impact. Prolonged uncertainty about future rates could chill economic activity. By cutting rates decisively, the Fed encourages borrowing, spending, and investment now. However, they must be careful not to overdo it, as aggressive cuts could lead to a surge in inflation. You've probably heard the saying, "Don't fight the Fed." It's a Wall Street adage that suggests it's generally unwise to bet against the Federal Reserve. The Fed has a lot of firepower at its disposal. When the Fed cuts rates, it's like turning on a giant fire hose of money. Borrowing costs go down, making it cheaper for businesses to expand and hire. Consumers can buy homes, cars, and other big-ticket items. This influx of money can boost economic activity and push asset prices higher. However, unforeseen events can thwart the Fed's efforts. Remember the global financial crisis of 2008. The Fed slashed interest rates to near zero, but it wasn't enough to prevent a deep recession. The same happened during the COVID-19 pandemic. The Fed injected trillions, but the economy still experienced a sharp downturn. In both cases, the Fed faced extraordinary circumstances. The Fed is powerful, but not omnipotent. Alright, so the Fed has made its move, cutting interest rates. The big question now is, how will the markets react? Will stocks soar like eagles? Will bonds rally like a winning team? Well, predicting market reactions is a bit like predicting which way a squirrel will run. It's unpredictable, to say the least. In theory, lower interest rates should be good news for stocks. It makes it cheaper for companies to borrow money, boosting their profits. Plus, lower rates make bonds less attractive, potentially driving more investors into the stock market. Bonds, on the other hand, typically don't fare as well when interest rates fall. See, bond prices and interest rates move in opposite directions. When rates go down, bond prices tend to go up, and vice versa. So, existing bondholders might see the value of their holdings increase. But here's the thing, the market doesn't always follow the script. Sometimes it throws curveballs. Investors are a fickle bunch, influenced by a whole range of factors, from economic data to geopolitical events to plain old human emotion. Global echoes. How other central banks might react. The Federal Reserve's decision to cut interest rates sends ripples throughout the global economy. Central banks around the world are watching closely and often follow the Fed's lead. Think of it like a synchronized swimming routine. When one swimmer moves, the others adjust to stay in sync. Similarly, central banks adjust their rates in response to the Fed, especially those with close economic ties to the US. It all comes down to exchange rates and capital flows. When the Fed cuts rates, it can put downward pressure on the US dollar. Investors might move their money to countries with higher rates, seeking better returns. If other central banks don't cut rates, their currencies could appreciate, making exports more expensive. So, they often match the Fed's moves to maintain stability. But not every central bank follows the Fed. Some chart their own course. The long view, a flood of liquidity. So we've covered a lot of ground here. We've talked about the Fed's decision to cut interest rates, the factors that led to this decision, and the potential market reactions. But what does it all mean in the grand scheme of things? One key takeaway is that the Fed's move is likely to unleash a wave of liquidity into the global economy. When the Fed cuts rates, it's like turning on a faucet, making it cheaper and easier for businesses and consumers to borrow money. This increased money supply can be a good thing, at least in the short term. It can stimulate economic growth, boost investment, and create jobs. But it also carries some risks. Too much liquidity can lead to asset bubbles, inflation, and other financial imbalances. Think of it like watering your garden. A little bit of water is essential for healthy growth, but too much water can drown your plants. The Fed is trying to strike a balance, providing enough liquidity to support the economy without overdoing it. Riding the waves of uncertainty. The truth is, no one knows for sure how this rate cut cycle will play out. The economy is a complex system, influenced by a myriad of factors, many of which are impossible to predict with certainty. Will the Fed's actions be enough to sustain the economic expansion? Will inflation remain in check, or will it rear its ugly head once again? These are the questions keeping investors and economists up at night. The best we can do is stay informed, monitor the data, and be prepared for potential volatility. The financial markets are likely to be choppy in the coming months, as investors try to make sense of the Fed's moves and their implications for the economy. Remember, investing is a marathon, not a sprint. It's important to stay focused on your long-term goals and not get too caught up in the day-to-day fluctuations of the market. Join the conversation. Well, folks, that's a wrap on our deep dive into the Fed's rate cut and what it means for you. We've covered a lot of ground, but this is just the beginning of the conversation. I want to hear from you. What are your thoughts on the Fed's decision? Are you optimistic about the economic outlook? Or are you concerned about potential risks? Share your insights, questions, and predictions in the comments below. Remember, financial literacy is power. The more you understand about how the economy works, the better equipped you'll be to make informed decisions about your money. So, keep learning, stay engaged, and let's navigate these uncertain waters together.